both. In that case, you'll be called as resident but not ordinary resident. So, this is how the residential status of an individual is determined based on the number of days they are staying or the state in India, and also to make it very simple, that is resident but ordinary resident but not ordinary resident. So, to make that very simple, it is also said that they need to satisfy both to only the two, that is 182 days is only to determine the residential status, but whereas to determine the resident but ordinary resident, in that case they need to satisfy both additional conditions as well as any of the basic conditions. Both additional conditions or any of the basic condition, means we have, as they have two basic conditions, an individual can satisfy one basic condition, and if you are satisfying only one basic condition you will be called as resident. But when you are satisfying both basic conditions also, you'll be called as resident. But when you're satisfying only, if you're not satisfying any of the basic condition, you're not satisfying any of the basic condition, in that case you will be called as non-resident, or we call it as NRIs. If you're not satisfying any of the basic condition, you're not satisfying, what are those basic conditions? The first one is an individual must have been stayed in India for a period of 182 days or more in the relevant previous year. So our previous year is what? 2023 to 24. That is 1st April 2023 to 31st March 2024. In this period, the resident, the individual must have been stayed at least 182 days, at least 182 days or 60 days. Means 182 days is for calling resident, and the other basic condition is 60 days, and it's not or, and 365 days out of 4 relevant preceding previous years. So preceding previous years means, as our previous year is 1st April 2023 to 31st March 2024, so preceding to that it will be 2022 23, like that every previous year, every year, that is financial year 2022 to 23, 21 to 22, 20 2020 to 21, 2019 to 20, and 2018 to 19, and also 2017 to 18, like this, 4 years only, that is 60 days and 365 days out of 4 relevant years. If this, out of these two basic condition, any one condition is satisfied, in that case you will be considered as resident. Suppose if you are not satisfying any of the basic condition, then you will be considered as non-resident of India, that is NRI. Apart from this, we have additional conditions. The additional conditions in that, the first one is 2 years out of 10 preceding previous years. Means we have, if we have to go for back 10 years, like from 2023-24 to that previous year, that is 2022 23, 2021 22, 2020 21, the 19 20. Like this, if you look at 10 previous years, in that an individual or the resident must have stayed at least 2 years. At least 2 years he might have stayed. Then they will be called as resident but not ordinary resident. Suppose if we satisfying both additional conditions, the other additional condition is an individual must have been stayed in India at least a period of 730 days or more during 7 previous years. So, two additional condition. One is 2 years out of 10 years, and the other additional condition is 730 days out of seven preceding previous years. If an individual is satisfying any one basic condition and two additional conditions, in that case, will be considered as resident but ordinary resident. Resident, ordinary resident. When they will be called? When is satisfying any of the basic conditions but two additional conditions. Satisfying one basic condition and satisfying two additional conditions, then they'll be called as ROR, that is resident but ordinary resident. Suppose they are satisfying one basic condition but satisfying only one additional condition, in that case, they'll be called as resident but not ordinary resident. This point should kept in mind while doing the residential status problems. Okay. The next topic is residential status of HUF. So here the residential status of HUF is determined as it is in the case of individual only status of like an individual resident and ordinary resident. But here we take how the business is carried out. Means HUF means it's a family business, and the head of the family will act as a karta who will look after the all the activities of the business. Karta is treated as the owner of the business. So whatever the business they are carrying out, if that business control and management, their control and management is wholly or partially situated in India, means it's not mandatory that full the control should be from India. At least partly is also considered as residential status only. It's called as resident. Suppose if the management and control of H is partial, only partial, then also they're considered resident. Suppose if the control management and control is totally outside India, in that case it will be treated as non-resident. And here also for residential status of an HUF, they have additional test. That is two conditions they have, additional conditions. That is same karta, that is the individual, whoever the head of the family who is acting as a karta. If he is staying at least 2 years out of 10 preceding previous years, and the other additional condition is 730 days or more during seven preceding previous years, that is also considered as the additional test, and they'll consider resident but ordinary resident. So here the only thing is they do in the basic conditions, like how individual is having 60 days, 182 days, and other, that is not available for the residential status of Hindu undivided family. For residential status of Hindu undivided family, only the whether the karta, the business, whatever the business they're carrying on, their control and management, is it in India or outside India. If it's totally outside India, it's NRI. If it's totally within India, it's resident. And if it is partially also, is considered as resident. And the additional conditions remains as it is for the determining the residential but ordinary resident. Next is residential status of a firm and other persons. Here, the residential status of a firm may be discussed as resident and non-resident. Under this, no need to employ any additional test that does not require it. Only the control, whether the control which is in Is it in India wholly or partially or both together? Then it will be considered as a residential status for any company. To call it as a foreign company, if the foreign companies are controlled and managed within India, then it is called as resident. But foreign companies control and management is outside India, then they are considered as non-resident. And if the foreign companies control and management is partly in India, then that is considered as non-resident. And even we have applicability for the poem, that is it's not poem, means it's not a poem actually. For determining the residential status of a company differed by 1 year. So here we can look out, that is how the tax is collected by based on their incidents, whether they are resident, ordinary resident, but non-resident. Okay. So for example, in income received in India, whether accrued or arisen in India or outside India, it's taxable. And income deemed to be received in India, whether accrued or arising in India or outside, that is also taxable. Income accruing or arising in India, whether received in India or outside India, that is also taxable for both the people, that is ordinary resident, not resident, non-resident also. Only the case is income received and accruable or arising outside India from a business control from a professional setup in India. So the control is outside India. In that case, only to the resident and resident, but not ordinary resident only, it is taxable. But for non-resident, it is not at all taxable. Income received and accrued or arisen outside India. In that case, it is taxable only to the ordinary resident and the other people, that is resident but not ordinary resident and non-resident, it is not taxable. So this is about the unit 1. Now let's move to the unit 2, where we talk about the incomes exempt from tax. Under the incomes exempt from tax, we have agricultural income, share of income from Hindu undivided family, share of a partner from his firm, interest on securities, that is bonds notified by the central government, and premium on the redemption for non-residents, interest on non-resident account, interest income from saving certificates, value of leave travel concession, incomes exempt in respect of foreigners, tax paid on behalf of a foreign company, tax paid by government or Indian company, tax paid by Indian company on behalf of a foreign state or foreign enterprise, income of a foreign company, allowances, perquisites for services rendered outside India, income in connection with any cooperative technical assistance program, income of a consultant, income of the employee of the aforesaid consultant, death cum retirement gratuity, pension, commutation of pension, leave encashment, retrenchment compensation to workers, payment under Bhopal gas leak disaster, payment on voluntary retirement, tax paid by an employer or any income by way of perquisites, life insurance policy money, payment from provident funds, payment from superannuation fund, house rent allowance, interest incomes, education scholarship, allowances to MPs, MLAs, awards made by the government in public interest, family pension to the heirs of a member of armed forces, annual value of one palace of ex-rulers of Indian states, and also like this around we have 100 and plus incomes which are exempt. So here we have 92 incomes which are exempt from tax. So if you are purchasing or investing or savings any of your amount or what is the income you are earning doing in these types of incomes, then that are totally exempt from tax. So here unit 2 talks about the incomes exempt from tax. Next is unit 3, which is income from salary. So income from salary means what, which income is called as salary. So as I said in the earlier class, that was yesterday, that we have five sources of incomes. We have, every individual has five sources of income. The five sources of income are, the first one is income from salary, income from house property, income from business or profession, income from capital gains, and the last one is income from other sources. So these are the five sources of income where an individual earns income. So here we have five sources of income, that is income from salary, income from house property, income from business and profession, income from capital gains, and income from other sources. So in that, now we are going to study the first heading, that is income from salary. So now we discuss about this salary. Actually, how do we attend at this calculation of salary part? What are the things that goes for the calculation of salary income? So here, features of salary income, we have employee and employee relationship, and salary may be paid either in cash or in kind. The salary of member of parliament. So the people, the members of parliament, that is MPs, whoever is relieving, is governed by salaries and allowances of MP, members of parliament Act 1954. It is not chargeable under the head salaries at all, because member of parliament is not a government employee, and the same shall be taxable under the head. Whatever they receive, na, that is taxable under the income from other sources. And they should have the employment. There is a difference between employment must be distinct from profession is different, and employment is different. And whatever the remuneration received by a partner of a firm, any salary, commission, bonus, fees, or any other remuneration received by a partner of a firm or by whatever name called, shall be taxable under the head profits and gains of business or profession. And the payment received after the discontinuation of services from his employer, former employer, is also taxable under the head salary. Now, if you look at here, salary from more than one employer, for example, it does not makes any difference whether the employee has received salary from one employer or from more than one employer during a financial year due to changes of employment. So ultimately, we tell that there should be a relation of employee and employer to call it a salary. To how do we calculate salary? Actually, what does salary includes? Salary includes basic salary, allowances. So salary we just call salary, but it includes basic salary, allowances, perquisites, and profits in lieu of salary. This all together, if you add these four things, that is basic salary, allowances, perquisites, and profits in lieu, that we call it as gross salary. That we call it as gross salary. And from this, if you did a standard deduction, that is section 16, subsection 1, and section 16 and subsection 2, that is entertainment allowance, and section 16, subsection 3, that is employment tax. If you deduct it, you'll get the income from salary. You'll get income from salary. The first one is gross salary. So how do we attain it gross salary? We add basic salary, to that allowances, perquisites, and profits only of salary. When you add all these four, we attain gross salary. From this gross salary, we have three deductions. If we deduct those three deductions, that is called income from salary. Now let us understand actually what all that comes under salary and what will come under allowances and what will fall under perquisites and profits in lieu of salary. Let us understand that. So just look at here. This is the format of income from salary. That is, salary means basic salary, bonus, commission, fees, overtime remuneration, leave encashment, and employer's contribution to RPF in excess of prescribed limit. Employer's contribution to RPF in excess of prescribed limit. So, what is this RPF? RPF is nothing but recognized provident fund. That we'll understand in due course. Okay. Recognized provident fund in excess of prescribed limit. Limit means what is the limit here? So it should be only 12%. It should be only 12%. If your employer is contributing more than 12%, in that case, the excess of 12% is taxable. The excess of 12% is taxable. Similarly, interest credited to RPF in excess of prescribed limit. Similarly, whatever the employer has contributed towards the RPF, on that we receive interest. So, how much interest should be there? Interest should be there only 9.5%. Only 9.5%. So that's why, because in excess of prescribed limit. Suppose if you are receiving more than the 9.5%, in that case, whatever extra we are receiving above 9.5%, that will be added to the total salary and it is taxable. It is taxable. That is part of salary. The next one is allowances. So allowances again we have three types, that is fully taxable allowances, partly taxable allowances and allowances not taxable. And next we have is perquisites. So under perquisites again taxable in all cases of employees, taxable in specified cases of employees, perquisites not taxable. Next we have is Roman number 4, that is profits in lieu of salary. When you add these four headings, salary, allowances, perquisites, profits in lieu of salary, we attain gross salary. We attain gross salary. From this gross salary, if you deduct the deduction, that is standard deduction, that is flat 50,000. Standard deduction is 50,000. Next is employment allowance, and the last one is employment tax or professional tax. If you deduct that from the gross salary, then it is called as income from salary. Now let us understand. Here we have studied four headings, that is salary, allowances, perquisites, and profits in lieu of salary. Now we try to understand what all will come under salary, what all will come under allowances and perquisites. So the first one is salary. Look at here, salary means what all is coming. Here we have like basic salary, wages, gratuity, fees, commission, leave encashment, overtime remuneration, bonus, advance salary, arrears of salary, annuity pension, refund from compulsory deposits, and employer contribution to RPF in excess of prescribed limit, and interest on credited to RPF in excess of prescribed limit. And the last one is transfer balance. So this all comes and falls under the income from under salary. And even we have leave encashment, retreatment compensation, commutation of pension, gratuity. This all also falls under the salary. The next Roman number 2 is allowances. Allowances means all allowances are liable to be included in salary because they are taxable unless they mention that they are not taxable. Okay. So here allowances again we have partly tax, that is fully taxable, allowances partly taxable and allowances not taxable. So allowances fully taxable, we have dearness allowance, dearness pay, city compensatory allowance, entertainment allowance, fixed medical allowance. So under fully taxable allowances, we have around 14, but now this has changed. It is it of allowances fully taxable are now 20 actually. They are 20. It says it's old material, it's showing 14, but now we have 20. If you just look at here, there we have project allowance, deputation allowance, family allowance, warden allowance, marriage allowance, overtime allowance, entertainment allowance, fixed medical allowance. So this all comes under allowances. Next is allowances partly taxable. So under partly taxable, the first allowance is HRA, that is house rent allowance. So house rent allowance is a allowance paid to an employee to meet expenditure incurred on payment of rent in respect of the house received or a house occupied by him for his residence. So for this we have three rules. Whatever the HRA is received from that, whichever is leased, that will be allowed as exemption, and it is actually exempt under section 10 subsection 13A. Under that, the first one is actual HRA received, and the next one is 40% of salary or 50% of salary in case of Mumbai, Chennai, Delhi, and Kolkata, and rent paid by the employee minus 10% of salary. Out of these three, that is actual amount received as HRA, 40% of salary in case of Mumbai, Chennai, and Delhi or Kolkata, it is 50% of salary, and rent paid by the employee minus 10% of salary. Out of these three, whichever is less, whichever is less, that will be given as exemption for HRA. So here we are calling salary 40% of salary, 50% of salary, rent paid minus 10% of salary. What does it salary means? Salary means basic salary plus DF is a part of salary plus commission on turnover. We calculate that, then we do the remaining part for the calculation of HRA. Next, partly taxable allowance. The next one is prescribed special allowance. Under that, we have traveling allowance, conveyance allowance, daily allowance, helper allowance, academic allowance, uniform allowance, newspaper allowance. Like this, we have different allowances. If these allowances are allowed, it is taxable to the extent of unspent amount is taxable and spent amount is exempted. And if you look at special allowance, to me the personal expense under this, the most important allowance to remember is children education allowance. Children education allowance, that is exempt of 100 rupees per month per child up to two children, and children hostel allowance 300 per child for maximum of two children. These two has to be remembered a lot, that are mandatory for the partly taxable allowances. So under that we have the last one is allowances that are fully exempt. So what are the allowances that are fully exempt? Let us see that. So allowances which are fully exempt is for a government employee posted outside India or who is in deputation in a foreign country, or the allowances under different names like overseas allowance, children education allowance, card allowance, or entertainment allowance. Foreign allowance is allowance exempt from tax, and sumptuary allowance to High Court and Supreme Court judges is fully exempt. Next is allowances from United Nations organization is also for employees is fully exempt. The next we have is perquisites. So under perquisites, the most important one is rent-free accommodation, and the other one is motor car. These two are very important perquisites that we'll discuss in the next class.